So good morning, everybody. I just wanted to welcome everybody to today's webinar. Just a reminder that the session will be recorded, so you can share it with your coworkers and anybody you'd like to after the fact. Will be on our YouTube channel. If everybody wants to mute their microphones, that would be great. And I will turn it over to Lauren.
Thank you, Wendy. Welcome, everyone. I'm Lauren Pilgrim. I'm the Regional Director for IG Wealth Management, and got the pleasure to introduce Mariska here today for our topic, which is going to be tax planning for business owners. A little bit of background on Mariska. She's Director of Tax and Estate Planning, and she holds her CPA, CA, TEP, and CFP designations. And she's a member of our Advanced Financial Planning team. And Mariska supports us in answering complex tax and financial planning issues that our clients encounter. She spent 13 years working in an accounting firm and primarily provided advice for to owner-managed business owners and high net worth clients. Since joining IG Wealth Management in 2015, Mariska has worked with primarily, again, owner-managers of private companies and on issues related to tax planning, succession planning, and she also has a specialty in cross-border issues. So a little bit of a focus there on US issues. So I'd like to welcome Mariska. And Mariska, I know we tried to organize this in person last year, but that got derailed, unfortunately. But I appreciate you taking some time to be with us today and to speak to the Fredericton Chamber.
Well, thanks for having me. It's been a wonderful experience to just connect with Lauren, trying to arrange for this. But yes, in person would be nice someday down the road. I am going to just share my presentation here, and I can share the slide deck after after our conversation here as well. One of the things that I help with is generally, the more complex files that come our way, clients who have a business and perhaps they don't know how retirement's going to be funded. And that's primarily what I want to talk about today. And there will be a number of strategies throughout the presentation that I see used a lot. So I kind of took, some of the ideas that I think have the greatest impact for business owners and put them together in a presentation. And I'll have a few stories as well. There's a few slides right at the back end that we might not be able to get to just for time constraints, but they generally deal with, families that come to us and say, oh, I'm selling a house, or I bought a property in Florida and I sold it, what happens? That also has to be layered in, but we want to primarily deal with business owners today and the tax planning that we regularly see done for them, and the things that maybe could make a real difference for the business owner as they face retirement. So I'm just going to advance the slide, and thanks, Lauren, for introducing me. So this first section, we're really diving into the planning for business owners, and I think the biggest thing there is, and I've said this, I think now for probably 10 years, we are dealing with a high tax rate environment, as you guys well know. And so we often end up talking about tax rates and, what type of income should be earned where, asset allocation and asset location, those kinds of conversations as well. And we'll talk a little bit about that. But the other thing I think that always is used to frame these conversations is, what type of income are you earning in your company, and are you earning it in the right spot? If there's an ability to transfer investments out of the corporation tax efficiently, we would normally do that. And I'm just referencing the PEI rates here. There's a very high cost to earning investment income through a corporation. Integration by and large works, we say. There's sometimes little mismatches and it's never perfect, but this is quite a significant cost for earning interest income inside your corporation versus earning it personally. So, top rate in PEI is 51.37%. The corporate rate is 54.67%. So you have an immediate, tax cost right there. And then when you actually pull it out as a dividend, your total tax is going to be 59.12%. So, that's the difference here, is you're paying a lot more tax on that investment income. Same thing holds true for capital gains. Obviously, we only pay tax on half the gain, so that cost is cut in half, 3.88. There's just a little bit of a cost to earning business income through your corporation. And I would say
Sorry, Mariska, I
sorry.
just want to jump in there. You,
Mhm.
you queued up the PEI presentation. We were, is the New Brunswick one.
That's
All
right.
good. All good.
That's funny. We are dealing with PEI rates, and I should have, just a minute here. I'm
Yeah.
going to go back because here, I'm just going to stop my video for a minute, and I'm going to unhide the rate slide. I'm sorry.
No, all good. We've got a good news story in New Brunswick on these rates. So
Yes, actually, and that's one of the things that we wanted to talk about. I had the wrong Fredericton. There you go. Here. Yeah, so in the rates in New Brunswick are a little different, and there's actually a bit of a, just 1 minute. There's a bit of a bonus there to earning income over $500,000, which is actually really neat, because it's a better experience earning that income. Just a minute for unhide, hide. And I just got my second slide because there's 2 slides that are affected by that. Okay, unhide and hide. So I'm going to just going to share again. Where's that button? Did I not? Oh, I'm still sharing, aren't I?
Yeah.
Yes, I am. Okay, so from the beginning, and there we go. So this is actually what Lauren was referencing here. So the active income with no small business deduction, there's actually a savings to earning that kind of income. So, we sometimes hear a lot of planning that's done, like preserve your small business deduction rate, don't earn anything over $500,000 in your company. And, there's actually a tax savings to earning that type of income. So to me, if you have someone who is earning business income and they don't need all of it, it's a no-brainer to me to incorporate in New Brunswick, because you have way more flexibility in drawing that income out in retirement when you're paying yourself a dividend. And so that's really important to keep in mind. So, small business deduction is worthwhile. If you lose it, that's not necessarily a game changer, because you've got the corporate tax rate, there's still a 29% deferral, you've got the tax savings. It's this type of income, I think, that you want to manage. And whether it's, by drawing it out as a dividend, or, leaning towards dividends instead of investment income, that's the kind of planning that we end up doing. And you can actually lean, right, within the corporate investments, lean towards dividends, and then in the personal investments, lean towards investment income and capital gains. So that's the kind of thing that we like seeing. So wanted to talk a little bit about the budget. The budget in 2021, everybody was looking for a couple of things. First of all, people are wondering, what are they changing for everybody that's going to pay for all these things that they've, distributed for, the CERB and the CEWS and all these other subsidy programs. How are they going to pay for all that? So everybody was kind of queued for, a tax rate change. And luckily, they didn't do that, which is good, because then, that high tax rate environment that we're talking about would actually be even made worse. So definitely not a great experience there. You can actually, I guess that was a gift to me. Like I read the 700 pages of documentation and I was like looking for something that was widespread. I found that there is very targeted measures in the budget. So, you know, someone who's looking at a luxury vehicle or a luxury boat, they're going to pay a lot more for that vehicle. But that doesn't affect many of my clients. My clients, you know, needed the subsidy and rent subsidies and lockdown supports to be extended. That's the stuff that is really making a big difference. And I'm just starting to see some of the financial statements floating past me for the last year, and they're making a big difference. There are some businesses that would have definitely had a loss without those programs. So good to see that they're stimulating economic growth that way. One of the things that I think was not talked about as much as perhaps should have been was this immediate expensing of certain capital expenditures. So what they're basically saying is that there's certain types of equipment that you can buy in this year, up to 1.5 million, that you can expense right away. And that will make a really big difference for some of our clients. So it's capital expenditures that aren't, you know, long-term spending, like class 1 to class 6 CCA is not included in that. There's a couple of other carve outs, but essentially if you are a farmer and you want to replace your whole fleet of tractors, you can do that this year and, you know, expense all of them. If you are a manufacturer and you've got manufacturing equipment that you're buying, you can probably expense that all in 1 year. So that's, you know, meant to stimulate the economy. There's definitely targeted measures too for clean energy and zero emission technology. And so all of that is trying to drive economic growth. There is also some measures in there about protecting the tax base. And so some of the things are, you know, definitely geared to companies with foreign elements, like, you know, a company that's doing business in Canada, but you know the parent company is in another jurisdiction. But one of the things that we did see was, and for me was a bit of a worry, was basically the CRA didn't like a result of one of the cases that was heard not too long ago. And in that case, the CRA asked for the auditor asked for an oral explanation for something instead of in writing. And that's always dangerous to me. I always prefer to ask the CRA auditor to submit their questions in writing and for us to respond in writing, because then I could control exactly what was being submitted. And you know, if they're going to ask for an oral explanation, does the person who's giving the oral explanation really understand tax laws and what they should be saying, what they shouldn't be saying? And you know, I'm not necessarily scared of the CRA, or you know, for them to come into a workplace and ask some questions is fine. But I do like to get the questions in writing so that we can kind of figure out, like, what are they looking at, and what do they need to see, and does that person who's providing that answer have the full picture of things? And so they did provide a little bit more clout in the Tax Act for CRA auditors, because they didn't like losing that one case. And so there's also some more funding to the CRA to audit. So, you know, instead of these wide sweeping tax changes, targeted measures aimed at, you know, stimulating the economy and making sure that the CRA had a little bit more clout, like I said. But I was glad to see no personal or corporate tax changes. And primarily, there's a lot of speculation about the capital gains rate going up. And we know that the inclusion rate, the last time it changed was actually in 2000. And I remember that because I was in tax class at the time and I had to remember the exact dates that the inclusion rate changed. And we've never seen changes since then. But this year we had an unprecedented amount of questions about, well, what do you think about the inclusion rate? And our stance has always been, you know, the inclusion rate could go up. It could go down, unlikely, but it could go up. But we don't recommend tax planning, you know, in light of that will prepay tax. Like, you have to be ready to prepay tax and trigger that capital gain now for other reasons than, oh, we're thinking the rate is going to go up, because lo and behold, sometimes it doesn't. And I was glad to see that it didn't. So that's kind of a summary of what I thought was noteworthy in the budget, just for business owners. Obviously, there's a ton of stuff in there, 725 pages or something like that. And it was quite a feat to try to summarize that all. But we do have a document on our website that's available to everybody that summarizes the budget, and you'll find a lot of additional information on these things in that document. So with a business, owner that comes to us, the first thing that we look for, and we often get asked about salary or dividend, but we do look generally for a blend. I like the idea of not putting all of your eggs in one basket. A few years ago, I wrote a paper for the Prairie Tax Conference that really spelled that out. Where should a business owner save for retirement? And I don't think it should just be in RSPs. I don't think it should just be in a TFSA because that's just not enough there. I don't think it should just be in the business, because then we've got this ginormous problem that we have to solve at retirement. Usually I would think it's a combination. Now we do look at, are you investing in the appropriate investment vehicle in the right spot, like we talked about before? I don't think the TFSA should be overlooked. Often our business owners come to us and they've just been busy running their business and they haven't looked at that. And I have seen the TFSA really make a big difference for people when they get to their retirement. We do look at their structure, and in order to understand if they have the right structure, we do need them to talk about their exit strategy, and we'll talk about that a little bit later. But all of these business owners are very similar. They come to us, primarily, when they're facing retirement and they're like wondering, I've built all this wealth and I've had some success, but what does it mean to me in retirement? And that's where a financial plan becomes really important. And we can also estimate what tax liability they'll have throughout their lifetime and on death. And then we can figure out, what's the right way to deal with that, or is there anything that we can do between now and then to mitigate that? And so that's really what we end up doing with the business owners, in tandem with the accountants and the lawyers. We get a much better result when all of us are working collaboratively for the client, looking at this in detail. And we'll show a little bit about our financial plan in a bit. But essentially, if you look at the pyramid of kind of strategies, the low-hanging fruit is, I'm going to look at the financial statements, tax return, share register, articles of incorporation, and I'm going to make sure that we've done everything that we can to strip out value out of the company if we can do so tax efficiently. So for example, if there's a capital dividend balance there, obviously you're going to take it out instead of leaving that money inside the corporation and earning and interest income that's taxed at such a high rate. And then we've got, income splitting with family members. That's not always a possibility, but sometimes we have people come to us and the non-working spouse has never been a business, has never been part of the business, but the business owner is turning 65. And it's too late to do that freeze and bringing in, the spouse as a shareholder 2 years or 3 years before the shareholder turns 65. I would like to do that a little earlier so that we have growth that we can pay out to the spouse that wasn't as involved in the business. And we have found that people are more involved than you think they are, but generally it's been undocumented. So trying to document all that is also important when you're trying to income split with family members. And income splitting is still, possible, like I said, at age 65, or if, the person has been working in the business, but maybe it's been a little bit sporadic and there's some years that they did and some years that they didn't. So we try to document all that. Some of the advanced strategies obviously are triggering gains. We know that that's the cheapest way of getting money out of the corporation if we can. But there's sometimes a bit of an aggressive strategy. Funding an IPP is also, I think, top of mind. I think IPPs are still heavily underutilized for business owners, and I think they can make a real big difference. We'll talk a little bit about that. And really, planning for the exit strategy. Are you set up to sell, or are you set up to transition well? And those are the kinds of conversations that we end up having with the business owners and their advisors. So in this case study, I guess for a New Brunswick company, if I have to think about the ordering of extracting money out of the corporation, I always have this framework in mind. So tax-free, anything you can take tax-free, take that out So that means repaying the shareholder loan, returning capital, paying out a capital dividend, then focusing on eligible dividends and obviously looking at the ERD TOH and the NERD TOH balances. And obviously, eligible dividends are favored over non-eligible dividends. You have quite a wide spread between your eligible dividend and your non-eligible dividend rates. And sometimes this is a little bit closer. So, but if you have a refundable balance sitting with the CRA, from a tax perspective and from a cash flow perspective, you'd want to pay that out because your rate on your eligible dividend is so much lower than 38% that you get back from the government. So, that's another thing that we would look at, keeping that eligible dividend stream going every year. And so we layer that into the financial plan as well. So we talked a little bit about this as well, but reviewing the business structure, making sure that there's income splitting opportunities. Is there anything that needs to be changed? I've also seen situations where children had participating shares with very low redemption values, and obviously those shares were just there to be able to income split with the children. But that was changed in 2017. And I'm a big fan of cleaning up those shares. I know that there's some people that would think, oh, well, just leave them because what if they put income splitting on the table again? But by the time that they put it on the table, maybe those children are in the same tax bracket or even a greater tax bracket than mom and dad. And so I'm a big fan of cleaning those up, because sometimes, those shares can be kind of messy later on, especially if there's a bad marriage or something like that. I just like redeeming those shares if we can, and cleaning up the structure. I always say nobody should be a shareholder that doesn't absolutely need to be a shareholder, because it just gets too messy later on. And I've seen that happen and play out as well. Considering your exit strategy is very important. So, we will sometimes recommend an estate freeze or just, envision kind of what will happen at death. Will the company be wound up or will we be doing a pipeline? Those are also things that we would look at. If you are going to sell, obviously, making sure that the structure is set up so that you can keep the corporation pure and extracting those profits where possible is important. And we also still will use family trusts to multiply the capital gain exemption where that's possible. But again, we need time there, right? You can't implement an estate freeze in favor of a family trust 2 years before you sell, or even even a little bit longer than that, because you need time for those shares that the family trust owns to grow in value. And so being proactive is really important. I've seen families freeze too early, and I've seen families freeze too late. So late, in fact, that dad held on to the shares so long that by the time that he wanted to pass down the business to his sons, who were in their 50s and 60s, the sons were wanting to retire and didn't want anything to do with the business anymore. They just spent their whole life working for the business and never owned anything. And so I think that's a missed opportunity. And so, these conversations are difficult. There's no doubt in my mind that we have to address some of the soft issues sometimes when you've got, people that are not wanting to face a time when they might, no longer be available to run the business, or that their kids are working and owning the business and making changes or decisions that maybe dad or mom don't agree with. So we are all about, facilitating those tough conversations. Some of the questions that I've asked before, how do you plan to exit the business? And sometimes business owners don't have a clue because they just haven't thought about it. But then I ask, oh, well, how did your friend with a similar business exit? What did they do? And then, it's easier to talk about those conversations sometimes. What are you doing today to make sure that you can exit? Is the company saleable now? Is there something stuck in that corporation that you actually want to keep? Like a cottage, which, is the worst thing to keep in your corporation, or, some other kind of personal asset. So those are the things we talk about as well. A hard question: what does the company look like when you're no longer involved? Do you think it can survive? What needs to be done to make it, viable? Is there anyone who can take your place? Are you training anybody to do what you need them to do? So those are things that we also end up talking to them about. The plan to exit really looks at, is there going to be a sale of assets? Is there going to be a sale of shares? Maybe a combination of, we've also done combinations of them. Or are you going to just freeze it and transfer to the next generation, and then your share is going to be redeemed over time? So, biggest message here is to be proactive. I've seen several families where the transition was done way too late. Business owner doesn't want to face death, plans to live forever. It creates a lot of uncertainty, and sometimes families don't end up talking to each other, which is, I think, a really big problem. But that is the way that families sometimes run. A family that doesn't want to talk about the transition and leaves it too late, there's usually hard feelings. There's people that have been working in the business that don't feel fairly compensated. People don't have confidence that they're going to be the leader, so they don't end up making any decisions, and they feel like they're players on the sideline. And then when it's time for them to step up, they're over it. And so those are very, very hard situations to see. And I feel like sometimes the family doesn't get the value out of the business that they should, because people generally can pick up on that if the family's not running the business as well as they should, and then maybe someone comes in and offers, makes an offer, and people are so tired of it they just accept whatever offer is given to them. So that's not a great example. A better example is someone who I know personally who wanted to transition his business, and he basically said, well, I don't need a warehouse as big as the one I'm going to build, but I know that I'm probably going to sell to that guy and he'll want this big warehouse. And so I'm just going to build that warehouse now, knowing that he's probably going to buy my company and I have the best spot in town. And so, that's the kind of conversation, and he was able to sell to that person. And they thought, they offered him exactly what he needed, and it was a really good opportunity to talk about business. So those are the kinds of things I think that people will sometimes focus on, but you need to be proactive. One of my favorite structures, obviously, is coming up on the next slide, but essentially, a conversation about bringing in Mrs. A, who maybe hasn't been active in the business, but Mr. A is about to be 65. We will sometimes have Mr. A exchange his 100 common shares for preferred shares, and then have Mr. A and Mrs. A subscribe for new shares. And so that dotted line, we will see Mrs. A subscribing for shares so that we can income split when they're retired. We've also seen situations before with a family trust, like I talked about. So Mrs. A and other beneficiaries are, the beneficiaries of a new family trust. Mr. A freezes his shares for preferred shares, and family trust will subscribe for 100 common shares. So those are, both things that we've recommended before. But my favorite, which offers the most flexibility, and I know this planning is done a lot out east as well, because I've run into it a number of times, is having an Investco be a beneficiary of the family trust. So basically what this does is you can, if you structure this properly, the operating company can pay dividends through the family trust, park a nest egg here in Investco. You'll keep this company pure. If someone wants to come along and buy these shares, you can, use Mr. A, Mrs. A, and all the other beneficiaries' capital gain exemptions if they're available. But this is really predicated on keeping this company pure. And so sometimes you need this Investco. And so this is the planning that we see most often still. And this is planning that I implemented, 15 years ago. Still holds true today. I think it's the best structure if you don't necessarily know how things are all going to go. This is the most flexible, but obviously there's some changes now coming with family trusts. And there will be more reporting that has to be done at the family trust level. I think it's going to be more expensive to do that reporting. So, it's probably also the structure that is the most expensive to implement and to drive. So we often refer to this as the Cadillac of planning. If you're going to park this in your garage, I want you to drive it. I don't want you to just, park it and say, oh, I bought a Cadillac. So that's the kind of planning that we see most often that provides us the most flexibility. And sometimes we don't need to implement, exactly this, but it's usually the plan that is always in our playbook. And we often end up talking to clients about this structure. So one of the things that I said before that I don't think is being used enough is an IPP. So, for a business owner that is, in their 40s or even in their 50s, we've implemented them more for people that are in their 50s. Essentially, what we look at is setting up your own defined benefit plan that's funded by your corporation. So the IPP is funded by your corporation. The drawback is that generally we have to transfer in all their RSPs, and it basically you don't have contribution room anymore after that. But the IPP's benefit is that it's like a supercharged RSP. You're replacing your RSP savings with an IPP, and you can actually fund more of your retirement with an IPP than you can with an RSP. And so, that's the benefit. We call it the supercharged RSP. And then at the time that the business owner retires, you have a couple of options. And even if we, were to transfer the locked-in amount and take out the excess amount out of the IPP at retirement, we've modeled this before in our financial plan, and the IPP generally will make a really big difference to that person's net estate. So, we're looking for companies that have a steady cash flow for people that are, in their 40s and 50s, who, could set up this IPP, who have worked for their business for a long time, paid themselves a salary, all these things. And once these criteria are met, we will look at the IPP, build that into their plan, and we find that they are making a really, really big difference. So I've modeled it a few times now in the last little bit, and we always look, and I'll talk about this a little bit later, but we look at the impact of the net estate, and the net estate is really what bakes in all of your assets, how your assets fund your retirement, the taxes that you pay throughout your retirement, what you're left with, at retirement, how you pay for your retirement, and the taxes that you pay on death. And so that's all baked into this idea of the net estate. And if the net estate is increased, then we know that we recommended a good strategy. And if it's decreased, then we know that it's not as good of a strategy. And I realize that some people will say, I don't want to leave anything to my children. But the net estate will generally say, well, you've got more money to spend during retirement. So the net estate is usually what we look at. And these IPPs can lift the net estate by, $1 million is the lowest number I've seen. I think the highest number I've seen is 2.2. And so they can really make a big difference for our business owners that are funding these IPPs with their business. It's a really great way of extracting cash out of the corporation and parking it into this IPP and reducing the passive income that you're generating. And remember, we talked about the high tax cost of the investment income that's earned inside corporations in New Brunswick as well. So those are things that we need to talk about as well. So we have a paper on IPPs that's available. And we also have a couple of articles on IPPs on our website, and I would encourage you to look at that. But I think IPPs are underutilized, and they should be. They should have more of a role, especially when we've got business owners that are coming to us that are looking at retirement. So, we're going to talk a little bit about building a plan, but inevitably, when we ask people, are you ready to retire? They're not confident. They say, well, am I ready? You tell me, right? And so the questions that they have is, how am I going to pay for my lifestyle? What should I draw from first? Where is the money going to come from? how much more tax do I have to pay? They're obviously tired of paying tax, and they think that in retirement they might pay a little bit less, and sometimes they find out that they won't. You know, a lot of people are even asking, can I afford to retire now and maintain the lifestyle that I want to live? But essentially, it all comes down to, am I going to be okay? So, you know, people just aren't as confident as they could be. And that's why we focus our practice on really building financial plans and layering in that business side. And we've had some really great success with working with accountants and showing them, you know, how we model that. So that's, you know, ideally what that's kind of like my favorite work, right? Ideally, that's the work that we're helping them with, giving people the financial confidence and knowing that the tax rules change and the tax rates change, like we talked about right at the very, very beginning. This plan isn't static. It's not a set it and forget it. I'm not telling them, take this out of your RSP, you know, every year, take this out of your business every year, and we'll never revisit it, because that's not smart either. The plan is reviewed and updated, ideally once a year. And essentially, you know, having that plan set out, we generally can help clients see, you know, what their retirement's going to look like, and that exit strategy, how it plays out for them. And like I said, it shows how retirement will be funded, and it estimates tax throughout your lifetime and on death. But it's all about giving that person that confidence to say, I'm looked after, I'll be okay, I can spend what I want, or maybe I can't spend what I want and I should wait, you know, a year or two, but then I'll be able to afford to retire, kind of thing. So that's the whole name of the game. And what we often focus on within that plan is to smooth out your taxable income. And so we want no year where you pay a lot of tax, and we don't want a particular year where you pay hardly any tax, because you know, it's just not a good use of your tax brackets. And so I have a couple of stories about that in a little bit. But essentially, you know, with these business owners, if they come to us and they say, oh, I want to sell my property down the road, I'm going to have this gain. Well, is there anything that we can do to manage the other types of income that year to avoid that? Or, you know, if there isn't something to be done, you know, then at least we are aware that you're going to have this one really high tax year, and we're going to tell you about old age security clawback and things like that. So, you know, obviously we'd look to smooth it if we can, and if we can't, then, you know, then at least be prepared for the tax bill, kind of thing. And we certainly don't want to see any year where the client doesn't pick up any taxable income, and we've certainly run into that as well. You know, and sometimes we end up talking about things like medical expenses and disability, and how that works, and that's also very important. So the idea is to smooth out your taxable income as much as you can, and that applies for almost anyone. I don't know of anyone where that doesn't apply. So we often end up modeling that out in the financial plan. We talked a little bit about the TFSA. I still see people that aren't using them, and those accounts can have a really big impact. What I love about the TFSA the most is that in retirement, if someone comes to us and says, oh, I have this big, I want to buy, you know, people are not going on holidays, but they want to buy a motorhome. I want to buy a $200,000 motorhome. Where should I pull the money from? Well, the TFSA gives you a lot of flexibility to access money without triggering taxes. And so, yeah, I know that when you take it out of the TFSA, you want to replace it, but you can do that over a number of years. That TFSA is just wonderful that way. And also there's no tax liability associated with it at death. And so, you know, sometimes we've even recommended, if we've got a couple and someone is terminally ill and they haven't used their TFSA, we tell them to top up that TFSA for the person that's terminally ill, and then make sure that the spouse is a subscriber beneficiary. So all that TFSA, you know, money can be transferred to the surviving spouse, and you know, it can build for that surviving spouse tax-free. And so, you know, even that sometimes ends up being discussed at these meetings. We have an article, a couple of articles actually, about income splitting with, and I don't want to dive into it too much because we're going to run out of time if we do. But essentially, we are still suggesting family investment trusts to certain families. So essentially, what you do there is you set up a family trust and you loan money to that family trust at 1%, which is the current prescribed rate, which we love. Basically what that does is it allows the trust to allocate income to family members that are maybe in a lower tax bracket. There are some restrictions, obviously, on the type of income that can be earned in that trust, but it's all explained in that article that I'm referencing here in this link. And obviously, the trusts are a little bit more expensive now because there's additional trust obligations and requirements that are set to be introduced this year. It's actually sitting in proposed still. I keep checking my Income Tax Act when I get my new one. These rules were proposed quite a while ago and they still haven't been implemented, but they could be any day. So we're all kind of preparing for the idea that the trust returns are going to become a little bit more expensive, but they are going to require a little bit more information. So it would be good to talk to the accountant and say, what do you charge for a normal trust return, or what do you think is happening with the trust fee? And those are conversations that we can have as well. And really, it's a solution for 21 years, but usually 21 years is enough to at least kick some of that down the road and to be able to income split with kids, with lower income family members during that time. So, we have a lovely article that's written here that you can access. And the other thing that we often talk about is the prescribed rate loan to a spouse strategy as well. And again, it's a high income earner that has some cash, lends it to the lower income spouse at 1%. The lower income spouse invests that money, earns that investment income in their return, deducts the interest they pay to the lender. The one thing that we always caution about here is you have to physically cut a check that interest every year, otherwise you taint it forever. So obviously when you set this up, make sure you set yourself a calendar reminder, or better yet, have a couple of people remind you maybe in a letter that you have to cut that check every year. And essentially, the future growth can be transferred to your lower income spouse using that strategy. And again, we have an article that you can refer to. So we talked a little bit about this estate analysis and why we look at that already. But really we do focus on, is the net estate being increased, improved, or is it decreasing? And that's how we filter all of the transactions, all of the recommendations that we're making. And I'll tell a few stories here. So we had a situation where we had a professional that was looking to retire and move, and they were moving from a lower tax jurisdiction to a higher tax jurisdiction, and looking to retire, in their cottage actually. So they wanted to move to their cottage. So we talked about a few things, a few strategies. And if you look at it's very small, I know, but the final estate was going to be about 2.1 million in 2057. And then we layered in a few strategies, and we increased that from 2.1 to about 2.3. And so there's only $200,000 difference. I get that, but the stuff that we recommended wasn't, crazy. It wasn't anything that was super hard to implement. So first of all, we made the recommendation to say, you're owed money by your corporation right now. Why don't you repay that and use that to maximize your TFSAs and contribute to it after? And the rest of it could be invested in a non-registered account, right? So we're increasing that projected net estate from 2.19 to 2.3. We also will look at when is the right time to claim old age security and when is the right time to claim CPP. And I get it that our plan always, we have to plan for at least age 90 when we're doing our financial planning. Sometimes we like to go to age 95 or 100. It really depends on the client sometimes and what their preference is sometimes as well. But our plan is always going to be biased to say, if you live a long life, you're better off delaying CPP to age 70 and old age security to age 70 as well. And so those are the kinds of conversations we do end up having. But sometimes people say, well, no, I want my old age security the minute I can have it. So we do have those conversations as well. And our plan is naturally biased, obviously, to delaying because we automatically assume longevity, which is not always the case for people. So but at least it's worth a conversation. And especially if your client is going to be on old age security clawback territory, then obviously delay, right? And we basically project out the marginal tax rates that the client is going to be in for, this year and all of the other years. So that's the benefit of the plan. So, it wasn't a lot of recommendations. He had a pretty clean structure. We know what his exit strategy was going to be. He was going to wind up his professional corporation. He wasn't going to sell to anybody. And then we ended up, increasing a little bit of his net estate. So the other example is a retiree with a corporation. And it was almost like he was paralyzed after he sold his business. He didn't know what to do, so he didn't do anything. So he just had left his cash, in the corporation, didn't pay himself a salary or a dividend at all, and lived off of his TFSA, which is probably the worst plan. So the recommendations were: we pay out the shareholder loan, pay out his capital dividend, we invest personally according to his risk profile, and invest in the corporation according to his risk profile. We topped up his TFSAs again. And we actually created a much smoother picture. So this was his tax rates before. So 37% was kind of holding steady. And then he was going to be in these, at age 72, he was going to be at these really, really high tax brackets. And obviously you can probably guess it to what's happened there. It's his RIF money coming out, right? And so by spreading that over more years, we get a much smoother tax rate and a much better result. And so in this one, the estate analysis went from 4.5 million at the end of his life to 8 million. So it was a $3.5 million lift, in his estate. And so that's the kind of planning that we end up doing with a lot of our business owners. And at this point, I'm not sure if we want to maybe stop for questions. I do have a few more slides that talk about some recent trends that I'm seeing. If we want to move that way, but I could stop here and just see if there's some questions that people have.
Yes, I forgot to mention at the beginning of the presentation that people can put any questions that they have in the chat. So anything that's there, I'll leave that for you to answer, Mariska.
Yeah, just gonna see here.
And if we don't have any, you could continue on if you like, whatever.
Okay.
Mariska,
I can
maybe I'll,
mm-hmm.
oh, there we go.
Yeah, I'll see if I could see it. Yes, the IPP can help purify the company, which is actually really a wonderful strategy for that. Good question on that one. So that's why another reason why I like IPPs. The IPP, I'm writing a whole paper on that, and it's going to be presented at the Prairie Tax Conference either this year or next year. I think that it's kind of up in the air, that one as well, as are all conferences now. But one of the things that people are very curious about are locking away this money and then being subject to the LIRA regulations, right? Like our business owners are usually very keen about, they want flexibility. They want to be able to access the money that they've worked so hard for. So they don't necessarily love, locking in part of it. And that's usually what ends up happening. So 95% of our people end up locking in the portion that they have to into the LIRA and taking the excess amount. That excess amount usually means that they're paying tax at the rates that they used to pay, before they retired. So they usually can overcome that. But then the locked in provisions, are something that they struggle with a little bit. But when we layer that in to the plan, we're still seeing a significant difference that's made. And part of it is, just being able to put more money away in this tax deferred vehicle, and then using that to fund the retirement. So, the IPP, like I said, there's an article that can explain it a little bit more fully. And I didn't want to just do a presentation on IPPs. Maybe Lauren can invite me to come back to you guys in person next year. We could talk about IPPs. But I think it's underutilized tool. And someone told me that 20 years ago, like, when I first started in tax, I remember we had, a course with a guy who's definitely, you know, top notch. And he kept saying to us, why aren't you guys using IPPs? Why aren't you guys using IPPs? Your business owner should be looking at IPPs. And I didn't really believe him. I was like, well, no, let's stick to salary and dividend planning and just focus on that, because that's what I was comfortable with. And then when the IPP, when we actually worked with it with our clients, we saw that they made a really big impact. So, you know, very, very much a noteworthy thing to talk about. I can talk a little bit about recent trends, like that's on the next couple of slides here, but we're getting a ton of questions about selling property right now. Real estate's obviously, you know, taken off, and people are not. Yeah, I'll move on to the next slide here, but people are wanting to sell their cottages and their homes, especially if they can't travel there. So we've got lots of people that are not able to spend time abroad, so they're just deciding to sell, or maybe they're saying, you know, kind of like it here, and they can't travel there anyway, so I'm just going to sell. Or sometimes they end up replacing their property with a different property. So anyway, we've got lots of questions about that, and those can have a really big impact on a financial plan as well. And so if we know that there's going to be some kind of tax event, you know, we obviously have to go back and adjust their plan. The other thing that we're finding is that with the work from home environment, I'm currently sitting in a little town, you know, south of Winnipeg, and we just renovated our basement to accommodate all that. And other people are doing the same thing. Maybe they're working from their cottage. But now companies are coming out with all sorts of new rules about, well, you can't really do your job from the States and move to your cottage and do your job from there. But people are asking. So those are the questions that we're fielding a ton of now. Hey, does work from home mean I can work from anywhere? And now I'm thinking about buying a property elsewhere, or, you know, I'm going to renovate that property. The other thing that I think people aren't aware of yet, and they should be, but it's missed, is that, you know, ever since the budget in 2016, people have to disclose the fact that they sell their properties on their tax returns, which means you have to keep receipts and you have to keep track of your cost base. So if you're making any capital improvements to your home, you know, keep track of all that. So there's a ton of questions about that right now, and it needs to be layered into their plan. And, you know, the inability to travel. Canadians are wanting to rent out their property down in the US. They've never done that before, but this year they're going to try. But they don't realize that they actually have some hoops to jump through and a tax return to file in the US. So those are things we're seeing. People who weren't able to travel and had a healthy travel budget, who are now wanting to buy motorhomes, like I talked about before, or maybe they want to, you know, travel the minute that the border opens up, and they can travel again, and their budget for that is now tripled. Those are the kinds of changes that we're seeing as well. People that are switching homes, like wanting to live in their rental and starting to rent out their principal residence and not realizing that that has tax implications for people. And we also are running into lots of people who are wanting to buy property from non-residents, and there's additional hoops to jump through as well there, or renting it out, because tax has to be withheld by the purchaser and remitted to the CRA. So those are the kinds of things that we're fielding a lot of questions about as well. Is there anything else that people wanted to ask about? No.
I have a question, Mariska, but I know we are spoiled having you in-house, so I don't want to take away the questions from general public. But
oh, you asked a good, yeah. Oh, sorry, Pilgrim, Lauren asked something here. But you can ask. Yes, we have time. Couple minutes.
Perfect. So in one scenario where you said, and I love your point on don't include people who are not actively in the business as a shareholder. However, you can add the spouse later at the retirement to use the income splitting afterwards, or for income splitting. When the spouse buys the shares, at what price would they buying the shares in retirement or at 65 into the company?
Yeah, so usually what we do is we have the like, let's say it's the husband that's been working in the business and the wife hasn't. What we have is the husband exchanging their current shares for preferred shares with a value that basically sops up all the value of the company today. So we're doing an estate freeze. So, let's say the business is worth $1 million. We exchange his 100 common shares for preferred shares worth $1 million. And then both husband and wife can subscribe for new common shares at a nominal amount,
Perfect.
right? So that's how you bring in the wife. And Lauren, great question here. When would you recommend starting to think about business succession? This is something that people just don't want to face. And I would like them to think about business succession when they enter into the business. But I know that that's probably not realistic. When you're talking to your advisors, your accountants, your lawyers about transitioning the business, you got to have those conversations, I think 10 to 5 years out at the latest, because we need time to plan, and we need time to set up your business properly and to clean it up. And so we often have people that will not think about this, and they will be given an offer and they won't have thought about given it much thought beforehand, and all of a sudden we have to do things in a panic, and sometimes we're restricted in what we can do. So at least 5 to 10 years out from the business transition, you got to be starting to think about this. I always, I see a number of people that have entered into business and not thought about the exit at the outset. And I would like to think that, we got to have those conversations right at the time that we're setting up the business, especially if there's, multiple shareholders. So my golden rule is don't bring on a shareholder or a business partner unless they're actually really contributing to your business and you need them. And if you don't need them, then scary as it is, just set it up and go it alone. And if you are going to bring on a business partner, then make sure you have a unanimous shareholder agreement that spells out what should happen if someone dies or someone is sick or someone wants out. And have those conversations when you're still wanting to enter into business together, instead of when you've tested the water and you've met some success, but all of a sudden something happens and you're dealing with an ugly mess. And so that's probably the most proactive advice that I can give on that front.
Great. Well, if there's no more questions, I just wanted to thank you for the great presentation. A lot of great information. Wow, all kinds of information for everybody, for
Yeah.
sure.
We have a lot of great articles on our IG website that are available to anyone. So I would encourage you to take a look there as well.
What is the website, just for people?
It's just IG Wealth Management. I'll have to. I'll send it out. I'll send
Okay.
out. I'll put a little bit of a package together, and I'll also send in it's under IG Wealth Management, and then there's insights and ideas. There's a tab, and there's a whole list of articles of this stuff that like we just talked about.
Oh, that's great. That's great. Well, thank you very much. So if anybody's missed anything, they want to clarify something, want to
Maybe
go
add
back
to
and
that, we
rewatch.
just, Mariska's hesitation there, we just changed domain or got a domain back in our control. So ig.ca will take you to the main site.
Great.
Yeah, I always seem to have trouble getting to that.
That just
But
came in yesterday, literally,
yeah,
Mariska. So,
okay.
Yeah.
So it's under
Yeah.
insights and ideas, and there's so it's me and my colleagues that have written. There's probably about 30 articles there, and we're always building on it with more recent stuff. So you'll find it and the articles about the prescribed rate loan and all that stuff are there as well.
Good.
Well, thanks for having me.
Yes, well, thank you. And as I said before, a copy of the presentation will be shared on the Chamber's YouTube channel. And we hope to have you back. It was a lot of great information, and hope to see everybody soon.
We'll talk about IPPs next time.
Right. Thank you, everyone. Have a good day.
Thank you.
Thanks, Al.